On April 22, 2026, CME Group reported first quarter revenue of $1.88 billion, up 14.5% year over year. Diluted EPS of $3.18 beat estimates by 4.6%. And here is the irony that defines this company. The same tariff chaos and macro uncertainty that hurt most businesses drove CME to one of its best quarters in history.
CME Group is the world's largest derivatives exchange. When the world gets more uncertain, when rates spike, when equity markets swing wildly, when trade wars send commodity prices careening, CME's customers need to hedge, and every hedge is a transaction that earns CME a fee. The market fear that tanked other stocks was literally good for CME's P&L.
Welcome to Charged Alpha. I'm Hudson Thomas, here with Lana Chen. Today we're breaking down CME Group Inc., ticker CME, the Chicago-based financial market infrastructure giant behind Treasury futures, S&P 500 futures, WTI crude oil contracts, gold futures, and a fast-growing Bitcoin and Ether derivatives franchise. 14.5% revenue growth, $4 billion in free cash flow, a 4% dividend yield, and a stock that is essentially a toll road on global financial uncertainty. Let's dig in. CME Group was founded in 1898 as the Chicago Butter and Egg Board, a marketplace for farmers and merchants to lock in commodity prices and manage risk. Over the next century, it evolved into the Chicago Mercantile Exchange, and then through a series of landmark mergers, the 2007 combination with the Chicago Board of Trade, the 2008 acquisitions of NYMEX and COMEX, it became the world's largest regulated derivatives exchange. Today it operates with 3,760 employees and generates approximately $6.7 billion in annual revenue.
The business model is beautifully simple. CME charges a fee every time a futures or options contract is traded through its exchange. It clears and settles those trades through a central clearinghouse that it also operates, and it sells market data to the financial firms, banks, and institutions that need real-time prices for those contracts. The result is a business that looks like a cross between a financial utility and a toll road. Most of the costs are fixed, so incremental revenue flows almost directly to the bottom line.
CME operates across 6 asset classes: interest rates, the biggest business covering Treasury bonds, SOFR and related products; equity indexes covering S&P 500, NASDAQ 100, and Dow futures; energy, led by WTI crude oil and natural gas; metals, led by gold and silver; foreign exchange; and agricultural commodities, including corn, wheat, and soybeans. More recently, CME has built one of the world's largest regulated crypto derivatives franchises, with Bitcoin and Ether futures growing at double-digit rates annually.
The why now is sharp. Q1 2026 was a perfect storm for CME in the best possible way. The Trump administration's tariff escalation created wild swings across equity markets, commodity prices, and currency markets. The Federal Reserve's ambiguous policy path kept interest rate volatility elevated. Every one of those market disruptions translated into more hedging demand, more futures contracts traded, more fee income for CME. Average daily volume for Q1 2026 came in at approximately 29.4 million contracts per day, up about 14% from Q1 2025.
CME Group is led by Terrence A. Duffy, known universally as Terry, who joined the CME floor as a trader in 1981, became a member of the board in 1995, and became executive chairman in 2002. He has served as the company's chief executive for over 2 decades and formalized the chairman and CEO dual role around 2012.
Duffy is one of the most powerful figures in global financial market infrastructure. He led CME through the CBOT merger, the NYMEX and COMEX acquisitions, and the launch of Bitcoin futures in 2017, a decision that gave CME an early institutional-grade platform for crypto derivatives when most exchanges were still figuring out custody. His operating track record is exceptional. Operating margins above 65% are a reflection of disciplined cost management and pricing power that Duffy has cultivated across his tenure.
The capital allocation story under Duffy is defined by CME's unique dividend structure, a regular quarterly dividend plus an annual special variable dividend tied to actual cash generation. In practice, this has delivered more than $11 per share in dividends on a trailing 12-month basis. nearly a 4% yield on a stock that has also appreciated dramatically. That's a shareholder return framework that has been extremely consistent. Let's get into the financials.
CME Group trades at $281.07 per share, giving it a market cap of approximately $102 billion. The trailing price-to-earnings ratio is 23.8 times. Forward PE, based on the run rate from Q1 2026, is approximately 22 times. Price to sales is 15 times, which sounds high, but is consistent with the company's 65% operating margin profile. Price to book is 3.79 times. EV to EBITDA is 18 times.
Walk us through the income statement.
Q1 2026 revenue was $1.88 billion, 14.5% year over year, from $1.64 billion in Q1 2025. That beat the consensus of $1.835 billion. Diluted EPS of $3.18 beat the $3.04 estimate by 4.6%. Gross margin was 86%. Operating margin was 69.7% in the quarter, a reflection of CME's near-monopoly position. Incremental revenue has almost no marginal cost. Net margin was 61.4% for the quarter. On a trailing 12-month basis, CME is running at approximately $6.76 billion in revenue and over $11.80 in diluted EPS.
And the cash flow and balance sheet.
Operating cash flow on a trailing 12-month basis is approximately $4.3 billion, and free cash flow is approximately $4.2 billion. Capital expenditures are minimal, under 1% of revenue, which is consistent with a marketplace business that doesn't need heavy physical investment. Now, there is one number on CME's balance sheet that requires explanation: total assets of approximately $202 billion. That is not a highly leveraged company. That massive figure represents clearinghouse margin deposits, client funds held in Treasury securities on behalf of exchange participants. The actual company leverage is trivial. Net debt is just $1.03 billion against TTM EBITDA of $5.7 billion. Net debt to EBITDA is 0.18 times. The company is essentially debt-free operationally. Overall, CME Group's financial health is strong. $4.3 billion in operating cash flow and $4.2 billion in free cash flow on 65% operating margins represent the earnings power of irreplaceable financial infrastructure. Net leverage of less than 0.22 times EBITDA gives CME extraordinary financial flexibility, and the dividend program returning over $11 per share annually is fully supported by cash generation.
What does analyst sentiment look like on CME?
Divided. 19 analysts cover CME Group. The consensus is hold. 9 carry buy or equivalent ratings, 7 are at hold or neutral, and 3 are at sell or underweight. That is a more contentious picture than you typically see for a business with 65% operating margins and near monopoly market structure. The bear camp is not questioning the business quality, they're questioning the valuation. At 15 times revenue and 22 times forward earnings, a number of firms believe the stock is priced for perfection.
Any notable calls to flag?
Several. Piper Sandler maintained overweight on April 15th, and Morgan Stanley maintained overweight on April 10th, both ahead of Q1 earnings. On the negative side, Argus Research downgraded CME from buy to hold on March 4th, citing valuation concerns after the stock's strong run. TD Cowen notably upgraded CME from hold to buy in January, arguing that the macro environment heading into 2026 was unusually favorable for exchange volumes. And JP Morgan has maintained its underweight rating. They've been consistent bears on the valuation for over a year. The price target consensus sits around $315, implying approximately 12% upside from today's level. The range runs from $270 on the low end to $360 at the high.
Let me make the bull case for CME. First, CME is a volatility beneficiary in a structurally volatile world. The macro backdrop that hurt most companies in early 2026, tariffs, rate uncertainty, geopolitical risk, directly drove CME's Q1 record volumes. That dynamic is not going away. Second, the interest rate complex is irreplaceable. CME dominates U.S. Treasury futures and SOFR derivatives in a world where trillions of dollars in debt and derivatives reference these instruments. There is no viable alternative to CME for these products. Third, crypto derivatives represent a high-growth option. Bitcoin and Ether futures at CME are growing at double-digit rates, and institutional adoption is accelerating. This is a new revenue stream layered on top of the existing franchise. Fourth, the dividend. $11.20 per share annually on a $281 stock is nearly 4%. That is exceptional for a financial infrastructure company growing revenues at double digits. Fifth, low leverage and fortress-like cash flow means CME can continue raising its dividend through economic cycles. 0.2 times net debt to EBITDA leaves enormous capital allocation flexibility.
The bear case has real teeth. First, valuation. 15 times trailing revenue is pricing in sustained growth and margin expansion. If volumes normalize from the elevated Q1 2026 level, say back to the 23 or 24 million contracts per day range from the pre-tariff environment, earnings growth decelerates, and the multiple has further to compress. Second, interest rate sensitivity is a double-edged sword. If the Fed achieves its policy goals and rate volatility collapses, CME's biggest product category volumes could drop sharply. A calm rate environment is the single worst scenario for the bull thesis. Third, the payout ratio of 92% is among the highest in the S&P 500. The special dividend is discretionary, and a down volume year could force the company to reduce the payout, disappointing income investors who paid a premium for the yield. Fourth, competitive evolution. Decentralized finance and crypto exchanges are creating parallel marketplaces that, while not yet a threat to institutional CME products, could chip away at speculative volume over time. Fifth, JP Morgan and Goldman Sachs having sell or underweight ratings on a business. This dominant is a signal worth taking seriously. These are sophisticated institutions with financial sector expertise.
How does CME compare to its peers?
CME's PS ratio of 15 times is dramatically higher than its exchange peers. Intercontinental Exchange trades at about 7 times sales, CBOE at about 8 times, and NASDAQ at about 7 times. The premium is justified by CME's operating margin. 65% operating margin is higher than any of those peers, reflecting the pricing power of its monopolistic market positions. On revenue growth, CME's 14.5% for Q1 2026 outperforms ICE's roughly 6% and CBOE's 7%, though NASDAQ runs closer to 11% given its technology diversification.
So CME is growing faster, but also trading at a much higher multiple.
Correct. And the question is whether that growth is durable or if Q1's volume surge was a tariff-induced one-time bump. ICE and CBOE are both excellent businesses with diversified revenue streams. ICE in particular has been expanding into mortgage technology and fixed income data, but neither has the scale advantage in U.S. derivatives that CME has. CME is the market structure. ICE and CBOE are competing within it.
What about the dividend picture across the group?
CME's nearly 4% yield is the standout. ICE yields about 1.5%, CBOE under 1%, NASDAQ about 1.3%. CME's yield is exceptional and reflects both the company's cash generation and its commitment to returning capital through the regular plus special dividend structure. That income component has attracted a significant base of institutional shareholders who prioritize yield.
On the options side, formal put-call ratio and implied volatility data were not available through our primary sources for this episode. What we do know is that CME carries a beta of 0.296, one of the lowest in the entire S&P 500, which structurally keeps implied volatility on CME shares compressed relative to the broader market.
The irony worth noting, CME, the world's largest derivatives exchange, is itself one of the least volatile large-cap stocks you can own. When the VIX spikes and everyone is buying puts, CME as a business is making more money, while the stock itself barely moves. That counter-cyclical revenue model is what makes CME a genuinely rare hold in a diversified portfolio. Heading into Q1 earnings, the setup was straightforward for options traders. Elevated macro volatility in Q1 was almost certain to translate into strong CME volumes, which is exactly what happened.
On insider activity, Formal transaction data was not available through our primary sources for this episode. What we know is that CEO Terry Duffy has maintained substantial personal equity holdings throughout his tenure, and CME's executive compensation is heavily tied to financial performance metrics.
The dividend structure itself functions as an alignment mechanism. When executives own stock and the company pays $11 per share annually, insiders are incentivized to sustain the business performance that supports that payout. The fact that no significant insider selling was flagged around Q1 earnings is consistent with management's confidence in the business outlook that Duffy described on the earnings call.
The key risks heading into the rest of 2026. Risk 1, volume sustainability. Q1 2026 ADV of 29.4 million contracts was elevated by macro volatility. If Q2 volumes normalize to 24 to 25 million, revenue and earnings growth will decelerate sharply and the multiple will look less supportable. Risk 2, interest rate environment. Any Fed pivot towards sustained low rates and policy stability could reduce hedging demand in CME's largest product class. Risk 3, payout ratio pressure. At 92%, any shortfall in earnings directly threatens the special dividend.
Risk 4, valuation compression. At 15 times revenue, CME requires continued execution. Any guide down or volume miss risks a re-rating toward ICE or CBOE multiples, which would represent 20 to 30% downside from current levels. Risk 5, competitive disruption in crypto. While CME currently dominates institutional crypto derivatives, the space is evolving rapidly. The watch point heading into Q2 is ADV, specifically whether the contract volume run rate from Q1 2026 holds through a potentially calmer macro environment in April and May.
What is the bottom line on CME Group? Q1 2026 was a strong beat-and-run quarter. Revenue of $1.88 billion, up 14.5%, beating estimates. Diluted EPS of $3.18, beating by 4.6%. And the stock sits approximately 15% below its 52-week high of $329.
The honest assessment, CME is one of the highest quality financial businesses on the planet, a near monopoly with 65% operating margins, almost zero leverage, and a 4% dividend yield. The debate is entirely about whether the current price captures too much of that quality already. At 15 times sales, the market is not leaving much room for error. The case for buying CME here rests on the argument that tariff-driven, rate-driven macro volatility is not a temporary shock but a new structural reality, and that in that world, CME's volumes stay elevated for longer than the bears assume. The key metric to watch is Q2 2026 ADV.
We'll leave you with Terry Duffy's message to investors for 2026. Our Q1 2026 results demonstrate the unique positioning of CME Group as the world's risk management marketplace. When global markets face uncertainty, participants turn to our products to manage that risk, and that dynamic drove exceptional volume and revenue performance in the quarter. A CEO who has run the world's largest derivatives exchange for over 2 decades is returning $11 a year to shareholders and is delivering double-digit revenue growth by providing the tools that the entire global financial system uses to manage risk. That's the case for CME at current prices. That's going to do it for this episode of Charged Alpha, your deep dive into CME Group Inc., ticker CME. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No signup, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.